I've been looking forward to have this guest on for quite a while. You might have heard of him, Ruchir Sharma. He is the New York Times best-selling author, What Went Wrong with Capitalism, also the Rockefeller International Chairman, Breakout Capital CIO, a man knows of what he speaks. Very good to have you. Thanks for joining us.
Thanks. Great to be here.
Let me first get your take on how you see the inflation report. It seemed to indicate, all right, the pressures are subsiding enough for the Federal Reserve to go ahead and cut. So it looks like a gift to the markets, save the Dow. It is not. What's wrong? What am I missing here?
I think there's a big narrative shift which is beginning, Neil, which is this, that for the last 2 quarters, economic growth in the U.S. is finally beginning to downshift. The point that I have made also in my book is the fact that the U.S. has been an overstimulated superpower. The incredible amount of fiscal and monetary stimulus that the U.S. put in helped U.S. economic growth remain very high and also cause inflation to spike. What we're seeing now is that that stimulus is beginning to wear off and that economic growth is now beginning to slow. So last 2 quarters, economic growth slipped. It'll be about 1.5% for the past quarter. And I think that by the end of this year, the economy comes to a virtual standstill as the stimulus runs its course. So what we're seeing here is this big narrative shift, I think, is beginning, that from now onwards, weaker inflation prints and weaker economic growth are no longer that great for the market, because even if the Fed cuts interest rates, I think that the economic slowdown story is going to be a bigger one in the months and quarters ahead.
You said until it gets to a standstill, and you seem to be saying, Ruchir, by the end of the year. In other words, growth stops by the end of the year?
Well, yeah, in terms of, it's very hard to know in terms of it, but I think that the momentum really is slowing down. So right. I wouldn't be, now it's very hard to know as to when you enter a recession or something. It's too bold a call to say recession. But the evidence I'm seeing is this, that the stimulus has run its course. The consumer is tapped out, because if you look at the excess savings that the consumer had accumulated during the entire pandemic and because of the stimulus, that's run out. So the savings rates of the consumer now is at very low levels. So I think that that's what's really going to happen out here. And the second very important narrative is this, that these big tech companies have been spending indiscriminately on AI and all the capex that they've been doing on AI and not missing out on that. But as the economy slows down, these companies are going to be a lot more cautious about how much they spend on AI, rather than this mad dash which has been going on in the last few quarters, that we need to spend crazily. But once the economy slows down and the revenues slow down, I think the companies will be much more sort of discerning about how much they're spending as well.
Well, that could interrupt a lot of momentum, particularly in the AI world. But Ruchir, one thing I do notice, and maybe the bond market is playing out what you're saying here. We got a 10-year now at little more than 4.17%. So they seem to be anticipating the very slowdown you're outlining, at least today. But we've seen days like this, Ruchir, right, where we have this downdraft in stocks. Not often, certainly not to the degree we're seeing, certainly in the NASDAQ today, but it doesn't last very long. And the buyers return, and the excitement returns, and if you want to call it froth, returns. What do you think?
Yes, absolutely correct. But there are a couple of cautious points here. One, that we track a whole bunch of sentiment surveys as to how extended is the market sentiment. And today the market sentiment is extremely bullish, very extended. So it's vulnerable to any setback. So that's one point I'll make. But the second, as I'm saying, is that so far as the economy was strong, it didn't matter, right? Because you come back, you know that these companies are going to come back and keep beating the earnings and stuff. But if the economy starts to slow down, then those earnings beats disappear as well. And I think that in the last few months, what we have seen is that the market's gains have been far higher than any earnings upgrades that we have seen. And it's all been very concentrated in a handful of stocks. So yeah, this could all come back. The momentum could well return. And we can talk about that 6 months from now where we are. But I still feel that the big story is going to be that the economy is slowing down. But I have one other point to make about interest rates as well, which is that I think the scope for the Fed to cut interest rates this time is going to be a lot more limited. And that's really going to be because of the fact that the deficit's also going to blow out. You know, the deficit today is already 6% of GDP when you have full employment. If the economy slows or, God forbid, comes close to a recession, the deficit will blow out to 9 to 10% of GDP. Wow. In that environment, the scope for interest rates to come down will be a lot more limited.
But lower interest rates would mean the cost of carrying that debt would come down.
Marginally, but I think that lower interest rates, because as I said, that it's going to be offset. It's going to have two effects. The economy is slowing down. The Fed's going to try and cut interest rates a bit, but it's going to be offset this time, unlike previous downturns, because the funding pressure is so high, the deficit's so high. So the long end of the curve may not come down that much this time because the funding pressure is so big when you're running a budget deficit of 9 to 10% of GDP and your debt to GDP is well over 100%.
Does it make any difference in your forecast, Ruchir, whether it's Donald Trump or Joe Biden in the White House come next January?
I think it's been a bipartisan project to how we have got here. Yeah. But what I argue in my book, though, is the fact that Biden has taken this economic experiment with bigger and bigger government to a different level in terms of what he's done with spending, what he's done on the regulatory front. It's just taken this, like, we're running on steroids on those fronts. So that's the core argument of my new book, really, that it's been a bipartisan project here as to what's gone wrong with capitalism. Why is it that after 100 years of minimal government, we have gone down to maximum government, and capitalism did not fail, it was ruined by big government.
Fascinating. Ruchir, don't go anywhere, because I did want to talk to you about the relationship between the Federal Reserve and specifically the White House. And we learned something, yesterday from a key congressman about that relationship that unnerved a lot of folks. Maybe it shouldn't, but I want to explore that with you and what role that is going to play, especially if we do get a rate cut before the election. That will feed this narrative that the Fed is doing politicians' bidding. But I do want to explore it, so don't wander too far. I'd like to tap your fine brain for that.